Have you ever pondered upon the real cost of your investments? Today, we get to the heart of this matter, untangling the knot of short-term versus long-term capital gains. Let's begin by defining capital gains. In the simplest terms, capital gains are the profits you make from selling assets. These assets can be anything from your home to your business or even stocks. But here's the twist. These gains don't all get treated the same way by Uncle Sam. The tax you'll pay on your gains depends on how long you've held on to the asset before selling it. This holding period is what differentiates short-term gains from long-term ones. So, as you can see, the timeline of your investment plays a key role in determining the real cost of your gains. Now let's delve deeper into the different types of capital gains and how they impact your investment returns. Short-term capital gains, a phrase you've probably heard, but what does it really mean for your wallet? Now, let's unravel this complex term and understand its implications. Short-term capital gains, in essence, are the profits you make from selling assets like stocks, real estate, or businesses that you've held for less than a year. The key distinguishing factor here is the holding period. If you've bought and sold an asset within a year, any profit made on that transaction falls under short-term capital gains. Now, you might be wondering, why does this matter? The answer lies in how these gains are taxed. Unlike long-term capital gains, which enjoy reduced tax rates, short-term capital gains are taxed as ordinary income. This means they're subject to the same tax rates as your regular paycheck. This is where things get a bit tricky, as the tax rates can vary based on your income level. In the United States, the tax brackets for ordinary income range from 10% for the lowest earners, all the way up to 37% for individuals earning over $500,000 annually. This means that the more money you make, the higher your tax rate will be on short-term capital gains. Let's consider an example. If you're in the 22% tax bracket and you make a short-term capital gain of $10,000, you would owe $2,200 in taxes on that gain. On the other hand, if that gain was considered long-term, you might only pay 15%, or $1,500 depending on your income. So, while short-term investments might seem attractive, remember the tax implications. Now let's move on to long-term capital gains. Patience is a virtue, they say. In the world of investments, it could also mean more money in your pocket. Welcome to the world of long-term capital gains. These are the profits you make from selling an asset, such as stocks or property, that you've held on to for more than a year. The beauty of long-term capital gains is that they are taxed at a lower rate compared to short-term gains. Now let's talk numbers. The tax rate on these gains is divided into three main brackets: 0%, 15%, and 20%. But don't let that 20% scare you. The majority of investors fall into the 15% bracket. Yes, you heard that right. Most folks will only pay 15% on their long-term capital gains. That's a significant decrease from the average tax rate of 22% for short-term gains. But wait, there's more. If your taxable income is on the lower end of the spectrum, you might not owe any tax on your long-term gains. That's right, 0%. Now, isn't that a delightful thought? All these numbers might seem a tad overwhelming, but remember, understanding them can be the difference between keeping more of your hard-earned money or giving it away to Uncle Sam. So holding on to your investments for longer can indeed be more tax efficient. But how do these two types of gains compare side by side? Short-term or long-term, it's not a simple choice, but understanding the differences can help you make more informed decisions. Let's dive into the comparison between short-term and long-term capital gains. One of the most significant differences lies in the tax rates. Short-term capital gains could be taxed as high as 22%, depending on your income bracket. This is because they're considered as part of your ordinary income. On the other hand, long-term capital gains are typically taxed at a lower rate. For most people, this rate is 15%. That's a 7% difference, which might not sound much at first, but let's put it into perspective. If you're realizing a gain of, say, $10,000, that 7% difference translates to $700. That's quite a sum you could have kept in your pocket or reinvested. This stark difference in tax rates underscores the importance of considering the timing of your asset sales. Holding on to an investment for over a year, thus making it a long-term capital gain, can potentially save you a significant amount in taxes. This is why many investors strategize their buy and sell decisions around these tax implications. However, it's important to remember that investment decisions should not be driven solely by tax considerations. The performance of the asset and the market conditions are vital factors to consider. After all, it's better to realize a short-term gain taxed at a higher rate than to hold on to an asset too long and risk a loss. So short-term or long-term? The answer isn't always straightforward. It depends on various factors, including your financial goals, risk tolerance, and the market scenario. By understanding the tax implications of short-term and long-term capital gains, you're better equipped to make savvy investment decisions. Remember, the more you understand about capital gains, the better equipped you'll be to protect your nest egg. So, what's the key takeaway from all this capital gains talk? Well, it all boils down to this. Understanding the difference between short-term and long-term capital gains is crucial for any investor. It's not just about the profits you make from your investments, it's about how much of these profits you get to keep after taxes. Short-term gains, those from assets held for less than a year, are taxed as ordinary income. This can be as high as 22% depending on your income bracket. On the other hand, long-term gains, those from assets held for over a year, are usually taxed at 15%. That's a potential 7% saving right there. And remember, capital losses can offset gains up to $3,000 annually, which can be a strategic move in your investment journey. By making informed decisions about when to sell your assets, you can significantly impact your tax liabilities and protect your nest egg. So keep these points in mind and make your money work smarter for you. Thank you for joining us today. If you found value in this video, please like and subscribe. And for more insights, don't miss our next video on investment strategies.